If you are an employee, you must have received a mail like this from the HR or the financial department asking you to provide your proofs of investments declared for the year. This, of course, is a standard practice and you must do it to avoid tax deductions from your salary. But what if you haven't made enough investments? Can you still avail some deductions? Also, what if you have made some investments later in the year? Is it still possible to save on taxes? Keep watching for all the answers. So, at the start of every year, employees are required to declare their investments to their employers, and at the end of the fiscal year, they have to submit the proofs of those investments. This is done so that the company or the organization can process these proofs, calculate the employee's tax, and submit the tax levied to the government. That is how your ITR form is generated. So if you fail to provide the proofs on time, you may have to pay a much higher amount of income tax. So in case you have evaluated your investments and are falling on short on investments, you can consider these 5 ways to save more. Number 1. Deduction under Section 80C. Well, whenever we talk about tax savings, Section 80C is something that definitely comes to our minds. This section provides deduction on various financial investment options ranging from PPF, EPF, life insurance policy premiums, bank FDs, and so on. Investments of up to 1.5 lakh rupees in one or more of these are exempt from tax. So in case you haven't exceeded this limit, you can consider investing in one of those options and provide proofs of the same to your employer. Second, you can claim tax deductions even on the interest you pay on education loans. So if you have taken an education loan for higher studies for yourself, your spouse, or children, you can claim a tax deductions on the interest paid under Section 80E. But do you know what's the best part? There is no limit on the deduction amount. You can take the benefit of this deduction for a maximum of 8 years or till the interest is paid, whichever is earlier. So if you haven't included this while you submitted your investment declarations, here's your chance. Number 3. Health insurance premium. Well, buying a health insurance plan can keep not only you but even your finances healthy. Yes, you can get tax deductions of up to 25,000 rupees on health insurance premium paid per annum. This deduction is double for senior citizens aged 60 years and above. You can claim deductions for health insurance premiums paid for yourself, your spouse, and any dependent children. Also, you can claim a separate deduction for health insurance premium paid for parents. And if one or both of your parents are senior citizens, the maximum deduction allowed is 50,000 rupees. Number 4. Interest on home loan. Availing a home loan is considered to be a very big decision. But do not forget to claim both the repayment of the principal amount and the interest paid on the loan. One can claim up to 1.5 lakh rupees under Section 80C on the principal repayment of the home loan. Apart from this, you can claim an additional deduction of rupees 2 lakhs on the interest component of your home loan for fully constructed self-occupied property under Section 24B. Lastly, if you have your savings kept in your bank accounts, like many do, make this note that you can claim a deduction of up to 10,000 rupees for the interest you earned on your savings account under Section 80TTA. And for senior citizens, this limit is 50,000 rupees per year. Lastly, this section is applicable to individuals below the age 60 years old and Hindu undivided family. Now that you've noted this down, don't wait until the last quarter of the financial year to start making your investments. You must always start planning your investments and taxes at the beginning of the financial year. This gives you more time to make informed investment decisions and stay invested for a longer period, which can help you reach your financial goals quickly. Lastly, check if any of your investments or expenses during the year are eligible for tax deductions. And if not, look for investment options as per your risk profile and invest the appropriate amount to reach your financial goals while also taking advantage of tax saving opportunities.